Historically, November and December have been good for equity markets, but what might make this year different? High valuations in the artificial intelligence space. It seems though right now nobody wants to leave the party. Let's get more from Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Great to see you.
Good to see you.
I mean, we do hear often, well, these hyperscalers, they're making loads of money, so they're not speculative stocks.
Well, yeah, you said it yourself. Everybody's kind of worried about the party and how far it's gone, and maybe people aren't ready to leave yet, but they're inching closer to the door. There's a great Morgan Housel quote that goes, every valuation is just a number today multiplied by a story about tomorrow. And right now, of course, that story is AI, and it leaves little room for disappointment just where the valuations have climbed. But one of the things that we noticed in Q3 is actually, even though the Mag 7 have continued to see excellent growth, and a lot of that comes with a lot of excess spending as well in AI and data centers and all that, but they really have they've seen the slowest pace of growth since early 2023. So that's something that I think is a cause for concern amongst many kind of AI investors, and maybe they're kind of triggering a little bit more defensiveness and building cash within their portfolios.
So the law of big numbers catching up even with the hyperscalers, their growth rate is beginning to level off.
Well, something that we've talked about with clients recently, if we've seen periods of exuberance before, I mean, the dot-com bubble is an easy example with the buildup of fiber and data centers, and that led to several bankruptcies and overspending as it became clear that there was overcapacity. Mm-hmm. This decade, it was lithium related to the electric vehicle demand promises and the buildup there, and of course that didn't work out. So even though I think a lot of the companies have said that they don't have the computing power necessary, and that's going to be cause for more spending. I think with valuations, again, just there's so little room for disappointments, and I think that's more of a reason to be active today. Maybe build a bit more of a defensive buffer within your portfolio.
We'll get to a few stock ideas in a second. I'm looking at some of these huge U.S. electricity generators like Constellation Energy or Vistra VST. Constellation is CEG. They've had a huge run, but they are off their highs. And people, of course, thought, well, there's going to be massive power demand for AI.
Well, I still think there will be. I mean, it's no secret that will continue to be a necessary need for the AI names. I think, again, the concern is that overcapacity and too much buildup, and AI promises don't work out as they maybe intend.
Broadly, what kind of stocks would you go into? The old dividend growth names, for example?
Well, I mean, it's funny you ask, because if you look at the valuations of maybe Microsoft, Meta, or Amazon today, they're actually trading cheaper than Walmart is. So it really, you have to have that conversation and actually do a little bit of a deeper dive into what you actually own and what the price is today, because price ultimately is what matters. There's a great example that I've used plenty of times going back to the dot-com bubble with Cisco. If you bought Cisco at the peak of the dot-com bubble, it took you over 20 years to get back to where you bought it. And if you bought it because you thought they were going to triple their revenues, they're going to be the backbone of the internet revolution, you were right, but you bought it at a terrible price.
Yeah, so it might be a great company, but bad stock. Martin Ray International, I like the look of this one, a player in auto parts.
Yeah, Martin Ray is definitely called a higher risk name on my list. They're an automotive supplier of lightweight structures and propulsion systems. Their customers include the majority of big autos in North America, Asia, and Europe as well. They're an interesting story. They actually just reported earnings yesterday, maintained full year guidance. Revenues were down, but I think a lot of that is due to the industry uncertainty and how the tariffs will ultimately fall and continue to impact them. We think that they have some really good levers to pull in terms of, they do have 75% of their revenues in North America. They do have some really great operations already in the US, so there is a chance to bypass some of those tariffs with some of the operations that they already have. There's also an opportunity to pivot to some of their European and Asian customers as well, with the operations that they have existing, if there's an opportunity to expand into those markets. But I think the low valuation, cares about a 2% dividend, and some promising growth opportunities make it a compelling entry this year.
Your next idea is Alaris Equity Partners. They're a grab bag of dozens of companies, more than 40 businesses. They're in industrial, I think they're in healthcare, aerospace, home retailing.
Yeah. Well, I mean, some of the bread and butter of the economy, really, and they've got an excellent track record. They're a team based out of Calgary, and they are an alternative financier of private businesses in North America. And they've done an excellent job. I think primarily the reason why investors buy them is typically for the yield. They're yielding about 7% today. But our price target for over the next 12 months is $25. We do think that they have some room to run as well on the capital appreciation side, which would serve investors well today.
And they're only distributing, you reckon, about 60% of their cash flow?
Yeah, their payout ratio is rather low. That's something that's any income investor is keenly aware of with an investment like this, which also gives them enough flexibility to maintain that distribution as well as deploy capital into new opportunities.
Do you think companies should be obliged to publish their payout ratio? Because it's confusing as well. Definitions of cash flow vary, but should the regulators make them disclose that to investors?
I think it makes sense from an investment perspective, but I think that's maybe above my pay grade.
Okay. Millicom International Cellular, now they offer telecom services in Latin America.
They do. So they're actually based in Luxembourg, but they're traded on the NASDAQ, and their operations are in smaller Latin American countries. Guatemala is about 30% of their revenues. They also have operations in El Salvador, Paraguay, Panama, Colombia, and they're interesting because they certainly have significant growth opportunities. There's a lower penetration in a lot of their markets for things like smartphone users. About 60% of their customers own a 4G smartphone. So there's opportunities on the upside from a data servicing perspective, but until then, the wireless and fixed line telecom side of the business will continue to be sort of their bread and butter and their big profit drivers. They've made recent efforts into some newer countries like Panama and more recently in Colombia. I think one of the catalysts for the stocks today will be that there is a pending acquisition that's held up by the regulators in Colombia. And if it were to go through, I think it'll actually draw a lot more attention to the stock. It's really an undercovered stock in that respect. And I think more coverage and more eyes on this will draw some more momentum in that space.
And you get a 6% dividend.
And you get a 6% dividend.
In the meantime.
Nothing to laugh about.
Thanks very much indeed for joining us. And thanks for coming to Scarborough. Great to welcome you here. Kyle Taylor, Wealth Advisor and Portfolio Manager at TriDelta Private Wealth.